The broadcast is now starting. All attendees are in listen-only mode.
Hi, good afternoon. Thank you all so much for joining us today for our May webinar on retirement income planning. For those of you joining us for the first time, my name is Amanda Sylvia and I'm the Client Service Associate for Stonehearth. I've been with the firm for 4 years now, and my primary role includes client service, marketing, and compliance. I just want to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all of them and we'll ask David to answer as many as time allows at the end of the webinar. But if we do run low on time and we're unable to get to your question, David or myself will reach out to you directly just to make sure we get your question answered. Now I would like to introduce our speaker for today. David joined our firm back in 2016 as a senior financial advisor, and he's bringing with him over 20 years of experience in financial planning and wealth management. And prior to joining our firm, David most recently spent 10 years at Commonwealth Financial Network, assisting over 1,500 advisors nationwide with complex financial planning solutions and building comprehensive wealth management plans for clients. He continues to bring his expertise to our firm by conducting portfolio reviews with our clients, co-managing client portfolios, and building, analyzing, and maintaining comprehensive financial plans. David also serves as a member of our firm's investment committee. David, thank you so much for joining us today.
Thank you, and good afternoon to everybody, and thank you for joining us for today's webinar on retirement income planning. Lots of great information to talk about with this topic, so let's jump right into it. The challenge with retirement income planning always is, where do we start with this? Retirement is often considered one of the top 10 scariest events in people's lives, and most people feel unprepared for it, and it's really uncharted territory for a lot of people, which really causes that stress sometimes around this change of lifestyle. And also too, you're thinking a lot about the fact that you're going from a accumulation phase of your life where you've been accumulating assets and building your accounts, switching over to a distribution phase, and this concern about, have I saved enough and how long will my portfolio last once I start to take money out? So that causes a lot of the concern around folks as they transition to retirement. So, a place to start really is asking the question, are you ready to retire? And that question is, as you would expect, more complicated than it first appears to be, because it demands consideration on two levels. First, there's the emotional component, and are you ready to enter a new phase of life? Do you have a plan for what you'd like to accomplish or do in retirement? Have you thought through both the good and the bad aspects of transitioning? And second, there's a financial component. Can you afford to retire? Will your finances support the retirement lifestyle that you want? And do you have a retirement income plan in place? So this planning really requires an honest assessment of how you envision your retirement. And to look at that, it's what does retirement mean to you? It's when you close your eyes and think about your retirement, what do you see? And over your career, you may have had a vague concept of retirement as a period of reward for a lifetime of hard work, and it's a period full of possibility and certain potential to do different things. But now that retirement is approaching, you need to be much more specific about what that is you want and expect in retirement as that gets closer. So do you see yourself pursuing hobbies or traveling, or have you considered volunteering your time or taking the opportunity to go back to school maybe, or starting a new career or starting a business? So it's important that you've given it some consideration and have a plan. And if you haven't, for example, if you thought no further than the fact that retirement simply means that you won't have to go to work anymore, then maybe you're not quite ready to retire. So it takes some visioning and some planning. And one of the questions that we think is important to consider and to ask is what percentage of your pre-retirement income do you think you'll need to replace in your retirement? And I'll just pause for a moment to let you kind of think about and maybe approach what you think your answer might be to that, it's actually about 70 to 80%. So you probably need anywhere from 70 to 80% of your pre-retirement income to live comfortably in your retirement. And if you think about it, your current income sustains your present lifestyle. So taking that income and reducing it by a percentage to reflect the fact that there'll be certain expenses that you'll no longer be liable for, like payroll taxes, or simply the fact that you've probably foregone maybe 10 to 15% of your current income to save for retirement, so you weren't living off of that portion of your income anyway. And that will 70 to 80% we find is a benchmark to really allow you to sustain your current lifestyle. Now, note that this is a guideline and a nice starting point, but the challenge with this approach is that it doesn't account for your specific situation. So you have to look at things that are pertinent to you and what your retirement income goals are. So, for instance, if you intend to travel a lot in retirement, you might easily need 100% or more of your current income to get by. So it's fine to use the percentage of your current income as a benchmark, but it's really worth going through an analysis of all your current expenses in detail and really thinking about how those expenses will change over time as you transition into retirement. So you don't always want to just think, oh, well, my expenses will reduce by a certain amount. That may or may not be true. So you really want to think about, do you have sufficient retirement savings to last throughout your retirement years and still enjoy the hobbies and plans that you have envisioned? So the quality of your lifestyle may depend on the financial choices you make when you retire, as well as leading up to that point. So some of these choices may be very complex and it may involve some issues you haven't yet thought of. So sometimes new expenses need to be budgeted for. You know, when you retire, you'll probably focus more on healthcare than ever before, and staying healthy is your goal, and this can mean more visits to the doctor for preventive tests and routine checkups. There's also a chance that your health will decline as you grow older, and increasing your need for maybe costly prescription drugs or medical treatment. And in this chart, you can see how healthcare costs have actually grown faster than the general level of inflation. And in this chart, the orange is healthcare cost increases and the green is general inflation. So you can see oftentimes in the past few to several years, healthcare cost inflation have outpaced regular inflation. And to account for that, we here at Stonehearth like to use 5% growth rates for medical expenses in our financial plans, just to reflect that these costs increase more than general inflation. So we want portfolios to be ready to absorb that when we do our retirement income planning. And also remember that while you're working, it's very typical to have your health insurance premiums heavily subsidized by your employer, which won't be the case if you retire. So if you retire before age 65, you will need to have some way to pay for your health care until Medicare begins. And if your employer doesn't extend health care benefits to you, you might need to consider other options, such as maybe buying a private health insurance policy. And if that's the case, we usually like to budget anywhere from $300 to up to $1,000 a month per person to do that when you're out there looking at a private health insurance policy. But then when you reach 65, Medicare begins, commonly referred to as the hospital insurance portion of Medicare. That's the free part that you automatically get when you enroll, and that can pay for your home health care, hospice care, and inpatient hospital care. But Part B is what helps cover the other medical care, such as physician care, laboratory tests, and things like physical therapy. You may also choose to enroll in a managed care plan or private fee-for-service type of plan under Medicare Part C or Medicare Advantage plan if you want to pay fewer out-of-pocket health care costs. And if you don't already have adequate drug coverage, you should also consider joining a Medicare prescription drug plan offered in your area by a private company or insurer that has been approved by Medicare. But unfortunately, Medicare won't cover all of your health care expenses, and for some types of care, you'll have to satisfy a deductible or make co-payments, and that's why many retirees purchase a Medigap policy if they have the original Medicare. And for Medigap policies or supplemental insurance, we budget in right around $400 a month per person, and those are the types of plans that you can get from Harvard Pilgrim or Tufts or Blue Cross Blue Shield. So it's important to do an analysis across those different insurance carriers to see where the premiums are going to be best suited for your situation. Something relatively new that we like to make people aware of is this concept of IRMAA, which is an acronym for Income-Related Monthly Adjustment Amount, which is used by Medicare. And what that basically is a higher premium charged by Medicare for Part B and Part D to individuals with higher income. So the standard base monthly premium for Medicare Part B in 2019 is $135.50 per month. But you start paying a higher premium amount due to that IRMAA when your adjusted gross income is above $85,000 for individuals and above $170,000 for joint filers. So there aren't many people that are captured by that increased premium, but you certainly want to be aware of it. And that's actually a test that's reviewed each year by Medicare. And what they do is they're going to look back 2 years on that. So for example, the Part B premiums that you're paying in 2019 are looking back to 2017 income. And if that 2017 income starts to go above those thresholds, then you'll start to pay a higher premium for your Part B. So we consider it very important to factor all that into your retirement income planning, because that'll obviously impact the expense that you'll have towards your Medicare coverage. And of course, the possibility of a prolonged stay in a nursing home weighs heavily on the minds of many older folks and their families, which is hardly surprising, especially considering the high cost of long-term care. Many people will look into purchasing a long-term care insurance policy, and a policy like that will usually cover a portion of the costs of care in a nursing home or assisted living facility, or even in-home care. But typically, those policy benefits don't cover the entire cost of care. We find that a policy designed to try to cover the whole cost of a long-term care event may be too expensive to pay for. For those considering long-term care insurance, you don't want to wait too long to buy it. You'll generally, you need to be in good health, and the older you are, the higher the premiums will be when you go out there to purchase a policy. We usually talk to clients around the age of 60 for long-term care insurance. So traditionally, retirement income has really been described as a three-legged stool comprised of Social Security, traditional employer pension income, and individual savings and investments. But with fewer and fewer people covered by a traditional employer or pension, the analogy doesn't really hold up well today like it used to. So increasingly, the more common scenario is to see the primary sources of income come from personal savings and investments, Social Security, and maybe some part-time work for some people if they continue to work after they retire from their full-time work. So the foundation of a retirement income plan is really first to determine the amount you'll receive from these income sources. So maybe you do have a pension, and then there's Social Security and perhaps some part-time work. So you want to start there to see what your sources of income will be, to see what gap might have to be filled from portfolio. And you want to be careful, though, if you are receiving Social Security benefits while you're still working and you haven't reached your full retirement age. So for years before you reach your full retirement age, which is age 66 for most people who are reaching that age now, if you are earning money before reaching that full retirement age, a $1 of your Social Security benefit will be withheld for every $2 you earn over what they designate as the annual earnings limit, which in 2019 is $17,640. So let's say you earned $10,000 over that limit, they're going to withhold $5,000 of your benefit. This gets a little more complicated than what we want to cover today, but the good news is those benefits aren't lost forever. Once you reach your full retirement age, they actually start paying you those benefits back. But nevertheless, you'd want to be aware that there is that part of the rules if you're going to work prior to your full retirement age. If you reach your full retirement age, you can work and earn any amount of money and they won't reduce your benefit. So let's look into these benefits a little bit further. The amount of Social Security retirement benefit that you're entitled to is based on the number of years you've been working and the amount that you've earned. So your benefit is calculated using a formula that takes into account your 35 highest earning years. And they will use zeros on any years where there weren't income just to get to that 35. So let's say you've worked 30 years, they're always going to use 35, so they would have 5 years of zeros in there, and then the 30 years where you actually had earnings. The earliest that you can begin receiving Social Security retirement benefits is age 62. If you decide to start collecting benefits before your full retirement age, which ranges from 66 to 67, depending on the year you were born, there is a drawback to consider. Your monthly retirement benefit will be permanently reduced if you claim prior to your full retirement age. In fact, if you begin collecting benefits at the earliest possible age of 62, your benefits would be about 25 to 30% less than it would be if you waited to your full retirement age. So the exact amount of the reduction will depend on the year you were born. But really, what you want to remember about this benefit is it's really the best income stream there is. It'll provide a monthly benefit each and every month for your life, and it's inflation adjusted. So each year they'll look at the general rates of inflation, and your benefit is subject to be increased a little bit depending on what the inflation is. Now, we have seen some years recently where there's no inflation on your benefit, and some years we'll see a small increase to the benefit. You also are rewarded by waiting to claim your benefit after your full retirement age up to age 70, which is at which point the benefit maxes out and there's no further benefit to wait past age 70. Now, some of the rules have changed over the last couple of years with these benefits, but certain people are grandfathered into the older and more favorable rules that were out there that have recently changed. So if you happen to be born before January 2nd of 1954, and you're married and haven't started your Social Security benefits yet, you do have some additional claiming options, and we can do some more detailed planning for folks in that situation just to make sure we optimize the benefits over one's lifetime. So we talked about the effect of filing at different ages, and this chart, it just helps to kind of spell out what that will look like from a percentage basis, both the percentage of reduction and percentage of increase you might get from your benefits. So as we look at this chart, this assumes a full retirement age of 66, which is people born between 1943 and 1954. For those born from 1954 through 1960, the full retirement age increases by 2 months per year. So in this chart, the primary workers benefit is shown in orange in the circles, and the spousal benefit is shown in the green boxes. So you can see right about in the middle of the chart, above age 66, which is the full retirement age for this illustration, you can see that the worker is getting 100% of their benefit, and the spouse would get 50% of the worker's benefit if the spouse did not have his or her own benefit to claim from. But you can see what happens after that by waiting. A worker can benefit by adding 8% per year to their benefit for each year they wait to start their benefit after age 66. But notice how the spousal benefit will always cap out at 50% of the primary worker's benefit. So if the primary worker claims at 66 and they're going to get $2,000 a month, and the spouse waits till their age 66 and they claim they can get $1,000 a month, which is 50%. But you can see how things are impacted by claiming a little bit early. If you claim at age 62 with a full retirement age of 66, then you're going to get 75% of your full benefit, and the spouse would get 35% of that benefit instead of 50. So important to be aware of the cost of claiming early and the benefit that you get by waiting a little bit longer. So as we talked about waiting to get a benefit later than your full retirement age, we discussed the increases that you can get, and those delayed retirement credits, they're called, when you wait to claim after your full retirement age, are very beneficial to get an 8% bump up per year in your benefit. Your benefit at age 70 would be 32% higher than it is at age 66. So usually when we're looking at lifetime benefits, you'd see a situation where you'd start benefits later, but because the benefit is higher, your lifetime aggregate amount of benefits that you receive is typically higher when you wait and claim at age 70 versus 66 or 62. So this type of break-even analysis is a good starting point to analyze what claiming strategy is best, but you really need to account for the claiming strategy that's best suited for you by looking at these benefits within your entire financial plan. It might look good on a break-even analysis like this to say, geez, it looks like it makes sense to wait till age 70. I'm going to get the most benefits over my lifetime. But waiting till age 70 might mean that you have to start going into your portfolio earlier if you retired prior to 70 and you need to fill that retirement income gap from somewhere else. So the break-even is a nice starting point, but important to look at your entire financial plan to make your final decision on when to claim. Most people aren't really going to be able to rely on Social Security retirement benefits to provide for all of their retirement income needs, and traditional pensions are becoming more and more rare, as we talked about. So that leaves the last leg of the three-legged stool, or personal savings, to carry most of the burden when it comes to your retirement income plan. And your personal savings are funds that you've accumulated in tax-advantaged retirement accounts like 401ks, 403bs, 457b plans, and as well as IRAs, and also any investments that you hold outside of tax-deferred or retirement accounts. And until now, when it came to personal savings, your focus was really probably on accumulating those savings as much as possible and building a large nest egg. But as you transition into retirement, however, that focus changes, and rather than accumulating, you're going to need to start to look at your personal savings in terms of distribution and income potential from that nest egg. So the bottom line, you really want to maximize the ability of your personal savings to provide annual income during your retirement years, which will help to close the gap between your projected annual income need and the funds you'll be receiving from Social Security and possibly from a pension payout. So as I talked about a few minutes ago, that foundation of your retirement income is to say, look at where am I going to get my first piece of my retirement income will come from any, more guaranteed income sources that I have. And from there, if there's a gap on the income that you need, then we'll have to fill that gap with these savings, personal savings and investments. So that shortfall can be covered by your portfolio, which may be generating some interest, some dividends, some capital gains, or maybe there's annuities that you have that can start to generate some income, and perhaps you'll also have to go into principal as well. Now, in practice, however, your choice of which assets to draw on first may to some extent be directed by the tax rules. So you can't keep money in your tax-deferred retirement accounts forever. The law requires you to start taking distributions called required minimum distributions, or RMDs, from your IRAs by April 1st of the year following the year that you turn age 70 and a half, whether you need the money or not. So, but note though, for employer plans like 401ks, RMDs must begin by April 1st of the year following the year you turn 70 and a half, or later the year that you retire. So if you're still working and you reach 70 and a half and you have money in your 401k plan, you can push off having to take money from that 401k plan because you're still working. But when you retire, you'll have to start to draw off that 401k plan. But whether or not you're still working, when you reach 70 and a half, you do have to start taking money out of your IRAs. Now, the good news on IRAs, if you do have more than one IRA, the required minimum distribution is calculated really separately for each IRA, but those amounts are then added together to determine your total required minimum distribution for the year. And the nice thing with having multiple IRAs is you can withdraw your total RMD from any one IRA or more. So you might have 3 IRAs and your required minimum distribution, when you add up all 3 RMDs from the 3 accounts, comes out to $7,000. Well, you can take that $7,000 out of just one IRA. You don't have to take it proportionally out of each account. However, note that if you do participate in a employer plan and you still have money in that employer plan, like a 401k, RMDs have to be calculated separately for that employer plan and be withdrawn separately from each one of those employer plans that you have. You can't aggregate 401k RMDs and take them out of an IRA, for example. So when these required minimum distributions start, you'll need to take out around 4%, and it grows by about 0.25% each year. It does trigger taxes. That's the whole idea where the IRS wants you to start taking money out of these plans, because it's considered taxable income that you'll have to pay. One way to get around that taxable income is a something called a QCD, or a qualified charitable distribution. That's a situation where the IRS allows you, when you have an RMD, to take up to $100,000 out of an IRA. It's considered to satisfy your RMD, and as long as that distribution goes right from your IRA to charity, then you won't pay taxes on that distribution, but you can use that to satisfy some or all of your RMD. Now, you can't also take a charitable deduction for that because you are taking it from pre-tax monies and donating it to charity. But the nice thing is you won't pay the normal taxes you would on an IRA withdrawal. So important to be aware of different strategies that you can implement if you don't actually need that required minimum distribution to provide for your general retirement living expenses. So taxes are important too, because it's usually taxes are usually the highest in the last few years that you're working. But if you retire before age 70 and a half, then we usually see a drop in the tax liability in between the time you retire and when you reach this required minimum distribution age. And then we see taxes maybe increase again after you have to start taking money out of your IRAs, because now you've got that increased taxable income coming out of the IRA. So sometimes there's a gap there where you have high taxes, then you retire, and maybe you have a few years of lower taxes, and then the taxes can increase again when you reach age 70 and a half. Now, be aware that we show here how the latest for your first distribution is April 1st of the year after you turn 70 and a half. Most people will take that first RMD in the year they turn 70 and a half, but you are allowed to take that, just that first one, you're allowed to delay until April 1st of the year after you turn 70 and a half. But if you do delay that first one into the year after you turn 70 and a half, then you'll have to take your second required minimum distribution in that same year. So we find that most people don't want to end up having two RMDs in the same year, so they'll take the first one in the year they turn 70 and a half, and then they'll take their RMDs once per year thereafter. Now, if you fail to take that required distribution, the penalties are pretty stiff. So, most companies that are holding your IRA will calculate what that required minimum distribution is. We do that for all of our clients, and we let them know exactly how much that is, and we monitor that to make sure that they take that required minimum amount out each year, whether they're getting it monthly or they just take it as one lump sum. But you'll pay a penalty of 50% penalty on top of the amount that has to come out. So you want to be careful to make sure you satisfy that RMD. So when we get back to looking at your retirement lifestyle and what that looks like as you're trying to generate retirement income, your lifestyle will really depend, not only on the asset allocation and investment choices, but also on how quickly you draw down your retirement portfolio. The annual percentage that you take out of your portfolio, whether it's from rates of return or the principal itself, that's known as your withdrawal rate. And your age and your income needs are the most influential on what could be considered a safe withdrawal rate. So if you take out too much too soon, you might run out of money in your later years. But if, on the flip side, if you take out too little, you might not enjoy the retirement years as much as you could have. So your withdrawal rate is especially important in those early years of retirement. How your portfolio is structured then and how much you take out can have a significant impact on how long your savings will last. So those early years are important. So for a withdrawal rate or a withdrawal amount, what's the right number? Well, it really depends on your overall asset allocation, projected inflation rate that's used, and market performance of the portfolio, as well as many, many other factors, including the time frame that you want to plan for. For many people, though, there's a basic assumption that an appropriate withdrawal rate falls somewhere in the 4 to 5% range. So that would mean in that first year of retirement, taking out anywhere from 4 to 5% of your portfolio in that first year, and then have that number adjusted for inflation going forward, is a general rule of thumb and starting point when we look at a withdrawal rate. So in other words, you're withdrawing just a small percentage of your portfolio each year, but it really is essential to think about how inflation can affect your retirement income over time. So you have assets and accounts that are tax deferred, like traditional IRAs, and some accounts that are tax-free, like Roth Iras, as well as your taxable accounts, the non-retirement accounts. So given a choice, which type of account should you withdraw from first? Well, if you don't care as much about leaving an estate to beneficiaries, then you might want to consider withdrawing money from taxable accounts first, then tax-deferred accounts, and lastly, tax-free accounts like Roth last. So the idea is that by using your tax-favored accounts last and avoiding taxes as long as possible, you'll keep more of your retirement dollars working for you on a tax-deferred basis. But if you are concerned about leaving assets to beneficiaries, however, the analysis is a little more complicated. You'll need to really coordinate your retirement income planning with your estate plan in that case. So, for example, if you have appreciated or rapidly appreciating assets in your taxable accounts, it may make sense for you to instead withdraw assets from your tax-deferred accounts or tax-free accounts first, because those accounts, like IRAs and Roth Iras, they don't receive a step-up in basis when you die. So, as many of your other assets will that are not in retirement accounts. So, the highly appreciated stock in your taxable accounts will receive a step-up in basis when you pass away, and those who inherit those assets after that tax basis have been stepped up will really be able to benefit from that. One way is another consideration is to really try to fine-tune your taxes as we're as we're planning. And one way to do that is maybe consider converting some of your traditional IRA over to a Roth IRA to kind of fine-tune what your tax liability will be. So taking a minute to look a little bit more at Roth IRAs to look at the advantages of it. Roth IRAs are a type of retirement account. There's no tax benefit when the money goes in. It's all after-tax money that goes in, but it's tax-deferred growth and then tax-free withdrawals on the way out when money comes out of a Roth. So it's really the best account around. It's really our favorite account type. Now, there are limitations on making contributions while you're working. If you make over a certain amount, you don't qualify for making annual contributions to a Roth, but anyone can do a Roth conversion, which is taking money out of a traditional IRA and putting it over to a Roth IRA. So there may be situations where you have a lot of medical expenses or you have large charitable deductions, and you may be able to limit your tax expense in any given year. Well, that might be a good time to say, well, let me take money out of my IRA. I'm going to incur taxes by doing that, but because I've got a lot of tax deductions in this year, I can take money out of my IRA, take advantage of those tax deductions, and then move that money over to my Roth IRA, which will be a more beneficial account type later on. So we see situations where someone might retire in their early to mid-60s, and we're still a few years away from having to take those RMDs from an IRA. So having a few years to convert assets from an IRA to a Roth IRA will essentially make that IRA a little bit smaller of an account when you get to that required minimum distribution point, thus making those RMDs themselves smaller, which will help to minimize the taxable income at that point. So the Roth conversion technique is really a way to kind of smooth out your taxes and maybe take advantage of a couple to a few years where you might be in a decreased tax bracket. So there's some of the other factors you'll need to consider in the context of your overall retirement income plan include your general asset allocation, and that the challenge is really to provide with reasonable certainty for the annual income you will need, while balancing that need with other considerations such as liquidity, how long you need your funds to last, your tolerance towards risk in your portfolio, and the anticipated rates of return. So the order in which you tap the various accounts, tax considerations, as we were just talking about, can really affect which accounts you should use first and which accounts you should defer until later. So the goal really is to construct a portfolio that will outlast you while you're considering things like inflation and sequence of returns and your expected mortality, how long your life expectancy is planned for. really what you look at, and what we like to do here at Stonehearth Capital Management is look at a diversified portfolio approach to accomplish that, and look at whether the emphasis is on preservation of capital while providing some income, or whether we're looking to provide some growth in the portfolio for a longer life expectancy while maybe still providing some income. So we really look at making sure your portfolio matches your risk tolerance, and we apply a risk score to portfolios so that we can compare the level of risk in any one portfolio to that of another type of portfolio. But the challenge always is that risk is not a static thing. That's going to change over time. So we use almost 50 factors in our portfolio research. These factors, these indicators, go into our investment model to really drive how we will construct our portfolios, and ultimately that helps us control risk and put it where the client is comfortable for their particular exposure to risk. We also like to emphasize not forgetting to name beneficiaries. So we like to look at a beneficiary audit on not just investment accounts, but annuities and life insurance policies. We see a lot of errors in this area where either beneficiaries that are named aren't the desired beneficiaries at the current time because of different life changes, or we see sometimes that there's been a failure to name contingent beneficiaries or secondary beneficiaries, even if a primary beneficiary is named. So important to look at beneficiaries. They can be changed at any given time, and it's also important to have those primary and secondary beneficiaries named on all accounts, and really keep all of that in good order. A lot of times people forget the fact that beneficiaries that are listed on things like annuities or life insurance policies and your investment accounts, those beneficiaries supersede anything that's named in a will, because those individual beneficiaries are going to receive those assets according to the fact that they've been named a beneficiary on that policy or that investment account. So it's easy to do direct beneficiary planning in those cases, but you may also have formulated a trust, and maybe you want to put those investment accounts inside of a trust, and then the language in the trust will dictate how those assets go out to beneficiaries. So the beneficiary planning can really be complex in some cases, or just very simple by naming certain individuals. So that part's important to look at and be aware of with your planning. That brings me to my conclusion today for all of the elements I wanted to discuss with you today for retirement income planning. It's a very broad topic and obviously includes many aspects to really get the retirement income plan to fit with your personal situation. Our goal today was to touch on many of those aspects that come into play and really highlight the areas that are important to look at, and with some of these important to dive into a little bit more. But I'll conclude there, and we'll see if we have any questions from the group.
Hi, David. So just want to remind everybody there is a questions portion on your GoToMeeting taskbar. So please, while we're just finishing up this questions portion, please feel free to submit your questions there. Also, if you do want to get into more of the retirement income planning, David did write a corresponding white paper, which is currently available on our website. And you can find it under the resources tab and then white paper archive. So that is currently available if you'd like to kind of go back and reread some of this information. And I know David went much more into detail on that white paper, so that is available for you all. So David, we do have a couple questions. The first one, when would you recommend someone delaying their first RMD until April 1st of the year after turning 70 and a half and having to take 2 withdrawals in that year?
Okay, yeah, we talked about that briefly where you can start your required minimum distributions in the year you turn 70 and a half, but you do get that one-time option on your first one to push that out into April 1st of the year following when you turn 70 and a half. But as I mentioned, in that case, then you'd have to take 2 RMDs in that year. But situations where we would recommend that would be sometimes a person who's working right up until that point, they may have worked for a portion of that year and they already had earnings in that year, or maybe they got some kind of a deferred compensation payout or some kind of bonus payout if they were recently retired. So if you already have income in that year, we might say, you know, you've already got taxable income this year, you're at a certain tax bracket, why don't we push out that first RMD out till next year? You'd have to take 2 in that next year, but overall, it looks like your income would be less in that second year, whereas if we take it in that first year, if we pile that RMD on top of income you've already earned, then now that RMD is coming in at a higher tax bracket. So that's really the most common example of where we would recommend pushing that out to the following year.
The next question I have is, if I work past the age of 70 and a half and I have a 401k plan, when do I have to start taking the required distributions from that plan?
Yeah, there's a nice advantage with that if you do have a 401k or 403b or other workplace retirement plan. If you're still working and you turn 70 and a half, provided that you're not a 5% or greater owner of the company, you can delay taking an RMD from that type of a workplace retirement plan until the year you retire. So if you work all the way till age 75 and you retire in that year, then you'll have to take a required distribution out of that plan. But note, however, though, if you have money that's already in IRAs, you'll still have to take required distributions out of the IRAs even if you work. So that rule only allows you to push off the required distributions from a workplace retirement plan like a 401k.
Thank you, David. And it looks like we just have one more. It says, if I claimed my Social Security benefit prior to full retirement age, but my spouse claims the spousal benefit at his or her full retirement age, will they still get 50% of my benefit?
Yeah, that's a common question, and we do see that a lot. So in our presentation today, we talked about a situation where, let's say, the primary worker claims their benefit at age 62, and they're going to get 75% of their benefit. So maybe they were going to get $1,000 a month at age 66, but they claimed at 62, so they get $750 a month. But they happen to have a spouse who was maybe a few years older than them, so when they claim at 62, their spouse is age 66, which is the spouse's full retirement age. So by the worker claiming their benefit, now the spouse is able to claim a benefit. And if they claim the spousal benefit at their own full retirement age, then they would actually get 50% of the worker's full retirement age benefit. So using this example, if the full retirement age benefit was $1,000 a month and the worker was claiming early and only getting $750 a month, if the spouse claimed the spousal benefit at their full retirement age, they would actually get $500 a month. So they'd get 50% of the full retirement benefit rather than 50% of what the spouse was getting. So in that example, a spouse could actually get more than 50% of what the worker is actually receiving. So some of those claiming strategies can be a little bit complicated and tricky, so it's important to kind of map it out in the financial plan to see what works best.
David, it looks like that's it. I just want to thank everyone again for joining us today. And David, thank you for presenting on this topic. Next month is CIO's Corner. We're actually going to be doing it the first week of August. So if you would like to sign up for that with our Chief Investment Officer, Chris, you can do so right on our website, and we hope you all can join us. I hope you all have a wonderful week. David, thanks again.
Okay, thanks everybody. Bye-bye.